Well, I feel like today it's like almost like announcing a winner of the lottery. Things have changed and it just doesn't take long for things to turn around. There's always these nervous things going on in the market that trigger this and trigger that. And yeah, I'm not going to try to untangle this. It reminds me of being a kid, and I had three sisters and they had those necklaces, and they'd always bring the necklace to me and said, "Hey, can you untangle these? It'd be a mess." Well, I'm going to turn it over to the guy who can untangle all of this. Today's a fun show. You're actually at the Mortgage Minute with Art Alvarez. He is the man from Mortgage Works who has been doing this for over 4 decades. And, even he has said, there's some things that have happened in the last, 6 months, 12 months that he really has never seen in this period of time. But at the same time, he always gave us one piece of advice: beware of the headlines. Don't hit the panic button. And today is absolutely the proof of that. So let's bring him on. This is Art Alvarez of Mortgage Works. Hey, Art, welcome to the show.
Hi, Jeff. Good to see you.
Good. You know what? I know it's got to be incredibly tough for the experts to predict what's actually happening in the marketplace. But you have been saying this since we first started the show now a few months ago, where you said, "Hey, watch out for those headlines. Don't get sucked into them," because let's face it, back in the 60s, the whole thing was, if it bleeds, it leads. So we had to sensationalize everything. Is that fair to say?
I think it is fair to say. And yeah, unfortunately, it seems like negative news sells better than good news. And so sometimes I think we fall in the trap of not paying attention when there is good news. As well, like last week was a pretty tough week in the bond market and the interest rate market. We've really done a 180 this week, as we'll get into. So just understand it's choppy. Things kind of move around a lot, and don't lose faith. Things are going to be okay eventually. So.
Yeah, I before we let you go, I just want to remind everybody, if you're watching this live, I'll be over here. I'm gonna bug out, but I'll be watching the comment section. So if you have any questions, please put them in the comment section. I'll feed it over to Art, and he'll answer those. If you're watching this afterwards in the recorded version, then again, put your questions in either the YouTube or the Facebook comment section, and Art will get to those afterwards. So with that, Art, I'm going to turn it over to you, and let's have a great show.
Okay. Thanks, Jeff. Well, hello, everyone. Art Alvarez at Mortgage Works, where we do have the answers, and they're on the house. And thanks for joining us for the show today. I want to get right into, again, some very good news that's occurred in the bond and interest rate markets just in the last couple of days, actually. And that is interest rates. They're much improved from a week ago. There's our rate chart. What you're going to see is quite a bit of change from what we were posting last week, when we had that really tough week with those super hot job numbers that really took the bond yields way up over 4%, and mortgage rates were essentially touching 7%. Well, we backed off of that quite a bit. So when you look at this rate grid, you can see now conforming 30-year fixed getting close to 6%. FHA and VA in particular, great improvement there. Now they're both under 6% and approaching the mid 5s. So this is really very good news this week for mortgage rates. So, and in that regard, let me show you the chart of the 10-year bond yield for the last 5 days. I've heard that there's still July skiing in Mammoth Mountain up in Northern California. And this chart kind of reminds me of one of those really good downhill runs at Mammoth, where you can see that, beginning last Friday into even Monday, we were over 4% on the 10-year bond yield. And as of, today, we're right around 3.76, 3.77. So that's a 3/8 of improvement in yield. And that's why those rates on our previous screen with the rate grid, that's why they're so much better than they were from the week before. So with that, what is going on? What happened this week to change the direction of mortgage rates? Well, it's all about inflation. Last week it was all about jobs. This week it's all about inflation. And guess what? Inflation is cooling. For this 12th straight month, we've had improvement in the inflation numbers. Now, starting with yesterday, Wednesday, we had the release of the Consumer Price Index, known as the CPI. Now, it increased 0.3%, but that increase was down from what it was in May, when it was 0.4%. So that was really, really good news. Now, keep in mind that core CPI, that does exclude food and energy, and it did increase 4.8% in June, but that was down 5.3% from May. And then today, so that caused quite a good rally in the bond market yesterday. And then we had more of the same today, because what happened today? The release of the PPI, or known as the Producer Price Index. And that rose by only 0.1%. That was an expectation to be a 0.2% increase. So the increase was only half of what was forecast. So as a consequence, what happened? We saw additional rally in the 10-year bond market. And now keep in mind, what is PPI versus CPI? Well, PPI is the price of goods sold by manufacturers. In fact, in that regard, it's sometimes known as wholesale inflation indicator. So both on the retail side of inflation, CPI, the wholesale side of inflation, PPI, we're seeing very good improvement in the inflation numbers, and it's been very consistent month to month. So with that, that's why we see so much better rates than we saw a week ago. And this is why, if you've been still holding off about maybe getting a mortgage, whether it's a purchase or a refi, here's another opportunity. If we can get a little more improvement, get well into the fives again, I think now may be the time to really look at getting a mortgage if you need to want to move, buy a house, or even if in some cases a refi. So good news all around. Again, we'll see what happens next week, but at least this week, it's definitely been definitely favorable. So with that, I want to go ahead and move over to another subject, and that is home prices. Now, every week, as I mentioned, I'll try to keep abreast of news as it relates to real estate, home prices, mortgage rates, et cetera. And what I found this week is pretty interesting, and so I want to go over it because within the span of about 24 hours, I found two articles forecasting the direction of home prices, and they were very, very different. The first one was by Black Knight. They publish and Black Knight is an analytics company, and they publish a home price index. And in their article, which actually came out a couple of days ago, they were projecting prices are going to be going up. In fact, they referenced the fact that the housing market is reaching an inflection point where prices may be showing a sign of going up sharply in the near future. And of course, they quoted some stats about that. For example, home prices rising at a seasonally adjusted monthly rate of 0.7 in May, hitting a new record high. And that was the fifth consecutive gain, and also completed a full reversal of the retreat that began last July, a year ago. And then they were pointing out on a year-over-year basis, home prices were down, but by 0.1%. But Black Knight expects that to change soon based on these stronger numbers in May. And they pointed out that this reheating, this sort of increase of home prices is pretty widespread nationally. 27 of 50 largest markets are at or above their prior home price peaks. So that's a pretty good indication of where home prices are going, at least nationally. They also pointed out the inventory problem. It continues. Active listings, again, this is nationally, have worsened in 95% of major markets this year and are more than 50% below pre-pandemic levels. That's probably the major contributor to why home prices are rebounding rather than falling, as has been predicted, which we'll get into in a minute. So, however, the other thing that Black Knight did point out is affordability. It is an issue. As it stands, housing affordability remains dangerously close to a 37-year low that was reached late last year, despite the Fed's efforts to try to cool the market. And the challenge for the Fed now, of course, is to pursue a path that will help us arrive at a soft landing without reheating the housing market and at the same time being able to rein in inflation. So with that, again, very bullish. Home prices are about to skyrocket, kind of like Barbara Corcoran, you remember a few weeks ago. Black Knight seems to be on the same page. Now, after I read that, within 24 hours, actually yesterday, I come across another article that was actually published by Fortune magazine. It was dated July 12th, and they were quoting an entirely different scenario. They were referencing Pantheon Macroeconomics, again, a firm that, of course, analyzes economic data. And they had a completely different scenario. They were arguing that prices are going to fall, that prices are down. In fact, they were predicting a rise in housing inventory will accelerate a 15 to 20% plunge in home prices over the next year. Now, that I kind of thought was a head scratcher. How could that be when Black Knight has a completely opposite point of view? This firm also pointed out that existing home sales continue to fall, that will a rise in supply will accelerate the speed and depth of the decline. Pretty depressing, right? Now, what they were attributing their forecast to is all about affordability, and that housing affordability is the issue. And they were pointing out that higher monthly mortgage payments suggest a meaningful recovery in home sales, and therefore prices is still a long way away. They called it miles away. And that's true. I mean, median mortgage payments for a median priced single family home, it's up 53% from what it was year over year. So obviously, yes, affordability is an issue. So intellectually, that's not too difficult to argue with, because affordability probably is the main factor in terms of people's ability to actually buy a home. Can they afford that mortgage payment? So what's going on here? Why would Black Knight have one forecast that's over on this side, and then the other outfit, Pantheon, has a forecast that's 180 degrees diametrically the opposite direction? Well, here's what I ended up finding out. Remember, I've said many times, beware the headlines. And I'll point out again, I shouldn't take credit for that. I first heard that comment, that quote, in an economic presentation by Dr. Christopher Thornburg with Beacon Economics. But it was interesting because ever since I attended that seminar, I have found his quote to be apropos so often. And I think this is another example. And this is why when I say beware the headlines, if you do get interest in a particular article, you really want to dig deeper, maybe read the whole thing, read the data, and then apply some critical thinking of your own to figure out what's going on. And here's what I found out. Here's what I discovered. The Pantheon macro article in Fortune published yesterday struck me as odd. So what did I do? I went to the Pantheon Economics website. And digging around, what I found was they had essentially made the same forecast that Fortune magazine published yesterday back in December of 22. And so then I had an aha moment. Okay, for whatever reason, Fortune publishes this article about Pantheon's forecast, even though the specifics of their forecast was something they were saying 6-7 months ago. And what I think that made me realize is that in reality, what Pantheon predicted 6-7 months ago hasn't proven to have occurred yet. In that regard, Black Knight seems to be more accurate in terms of using current data and making forecasts about where we go from here. And so in that regard, it kind of reminded me, I may have mentioned before, I have a little piece of paper that says that I know something about economics. It's my college graduation certificate. I have a degree in economics, and it's a great subject matter, but it's one of those things. Economics is oftentimes considered to not be a science, but more of a way of thinking. Now, I wouldn't accept that on its face. There is some science involved with economics, but economics is probably a more challenging science because it is a social science. And while there is hard data that all economists can rely on and research and investigate, they can still draw very different conclusions from that data. And so in that regard, just understand. And then one other thing I want to point out is understand that when it comes to economic headlines, news headlines, always realize that they're usually about not national trends, not local. Okay, so you have to read that information, take it with a little bit of grain of salt, and then kind of redirect toward focusing on your current market, your local market, to see if what's being described nationally is occurring in your actual local market. And in that regard, I've observed that. Here we are in this Coachella Valley. There's some differences in this market, for example, compared to Orange County. I just closed an Orange County loan purchase of a condo, first-time home buyer in South Orange County, and the borrower had to, make offers on multiple homes. Ended up having to offer a price over list before she successfully got the offer accepted and was able to complete the purchase. I'm starting one now, also in South Orange County, same kind of scenario. So in South Orange County, home prices are certainly not falling. In fact, on that lower first-time home buyer level, I would say they're still pretty firm, if not rising a little bit, because there are situations where home buyers, particularly first-timers, are put in a position where they maybe have to offer below list to successfully get that offer accepted. So just keep that in mind. There is national news, but then kind of relate that to your local market to figure out what's really going on. So again, very interesting. Beware the headlines, like I say, and understand that some of this material, even if it's published recently, may be dated and may no longer be appropriate or applicable to what's happening right today, right now. Next up, what I want to talk about, and this came up when I got a call from somebody here within the last week, and that was a prospective home buyer and was reaching out to see what I can do to help with regard to maybe getting them qualified to buy a home. And they shared with me that their concern was that they were, I guess, what I would call credit score challenged. So in that regard, I wanted to talk a little bit about what really are the options for a mortgage if you are a low credit score borrower. And what do I mean, first of all, by low credit score borrower? Well, I would argue that that really entails somebody who's somewhere between the 500 to 619 credit score level. That segment I would consider to be the low credit score borrower. Now, it used to be until recently, why is 619 the ending number? Well, until recently, the two federal agencies, Fannie Mae and Freddie Mac, in order to get a conforming loan that would be sold to those two agencies, you had to be at 620 or higher. Well, some time ago, they actually removed that. I think I pointed out in one of our episodes here in the last week or two, Fannie Mae and Freddie Mac removed that minimum. So you don't need 620 to get a mortgage that's going to be delivered to Fannie Mae and Freddie Mac. Now, some lenders still have that, what we call overlay, because they have the discretion to decide if they want to take in applications below that 620 threshold, even though the agencies they sell the loan to don't require that. But in general, you no longer need a minimum of 620 to get a conforming loan. So I want you to be aware of that. And then the other thing I would want to point out, and this I think is a little bit different in the mortgage market compared to past years and past several years. You may remember that back in the early to mid 2000s, even late 90s, we used to have a segment that was called subprime mortgages. Or alternative A mortgages. Well, subprime mortgages in particular specifically tended to serve people within this low credit score range. But there's really not what I would call subprime mortgages or subprime lending currently today. What is a little bit of a point of confusion is we do have what's called non-QM, that's non-qualified mortgage. Now, why? And I would argue with you that that is not a subprime mortgage. Why? Non-QM loans are not structured to serve low credit score borrowers. What they're really structured to serve are borrowers who are having trouble qualifying based on their documentation, specifically their income documentation. That's why you have these alternatives like bank statement loans or P&L only loans or W-2 only or 1099 only loans. These are all different programs to serve someone who can't really document their income to comply with what Fannie Mae and Freddie Mac require to get the loan. But all of those non-QM programs have relatively high minimum credit score levels. So if you're at 580 and you want to use a bank statement loan to document your income, that's going to be problematic. You're not going to find many choices. So as a consequence, what other options are there for a borrower who's got credit scores in this 500 to 619 level? Well, I think you're going to be surprised. For example, USDA. Again, that's also known as rural housing. And that is a program that allows for 100% financing. But your property that you're going to buy has to be located in certain census tracts that are more rural in nature. And so you have to determine if the address of the property you're looking for is going to be eligible for a USDA loan. For example, in our market here in the Coachella Valley, city of Desert Hot Springs is basically the whole city is eligible for USDA financing. And again, with no down payment. But what a lot of folks don't realize is you can get that 100% loan to value, zero down payment loan with a credit score as low as 580. That's pretty good. Now, of course, you still have to qualify for the payment. You still have to have the income, and that's going to be documented. And you have to have some assets gathered in order to cover closing costs, unless you negotiate the seller to pay it. But that's a very low credit score for 100% financing. Kind of reminds me of back in the day before the big crash of '08, we could do those piggyback loans, the 80-20 zero down with somebody who's in a 580 credit score. That was a little different though. USDA loans, from the perspective of documenting the borrower's ability to repay on the payment, that's still there. And with that step in the process, that 580 score is not so, it's risky, but it's not so risky that that loan can't be made. The other thing that a lot of folks don't realize, VA loans, which of course also offer 100% financing to a veteran, you can actually get a VA loan with a credit score as low as 500. Now, not every lender does that. I would say most lenders have an overlay at 550 or 580, and some even at 600. But I do have access to lenders where you can get a VA loan with no down payment at a 500 minimum score. So keep that in mind. Again, you have to qualify for the payment. So you do have to document your income. But of course, also remember, VA has no minimum credit score no minimum debt ratio requirement. So even if you're a little bit high in the debt ratio, with this credit score, it may still be possible to get that loan based on your residual income rather than meeting a specific debt ratio. And then the last thing I want to point out is FHA. FHA, which of course allows a minimum 3.5% down payment. And by the way, you don't have to be a first-time home buyer. Also, you can get an FHA loan with a credit score as low as 500. In fact, it reminds me, it's been a few years now, but I actually had a transaction that a past client of mine sold their home, and we're buying a brand new construction in the Banning Beaumont area. And they ran into some credit score problems because one of the borrowers started a business. It didn't go well. They had some credit problems. They maintained their mortgage payment on their existing home, perfect, no lates, but they had problems with their other consumer debt. And their qualifying credit score was very low. It's like 530. And the new home development they were at, of course, had an in-house lender because it's a big national home builder. And they didn't have an option for the buyer other than providing them a hard money loan, or what we prefer to call a private money loan, because of their very low credit score. Well, they came to me for some help, and I looked at the whole file. They had no trouble qualifying on income. They were providing a pretty substantial down payment, much more than the 3.5% down because of the sale of their existing home. And I actually arranged for them an FHA loan with that very low credit score at terms demonstrably better than the hard money or private money loan that their in-house lender that this builder had offered. So they were very pleased with that outcome. And it was just an example of how, even when you have credit scores in these levels, don't be too discouraged. Give us a call. I'm happy to listen to what's going on, try to get a better idea why your scores are where they're at, and see if I can help you with some of these loan options to get financing if you're interested in purchasing a home. Because it is possible. You just need to check into it further, talk to somebody like us. We love having the ability to help you when you think otherwise you don't have a chance, because in reality, in a lot of cases you do. Okay, so keep that in mind. Now with that, I want to go ahead and go to our closing question. You remember last week I had mentioned that over the holiday weekend, I had talked to some friends who were interested, or we started talking about qualifying for a mortgage, and they were under the impression, as very often is the case, that they needed like 10 or 20% down. So that was the purpose of this closing question from last week. So here it is again as a reminder. A married couple who are renters with high employment income have their eye on a home for sale at $1,125,000. But they only had $70,000 available for the home purchase. Are there any loan programs available for them to buy without saving a significant amount of additional funds for the down payment? Well, guess what? The answer is yes, there is. Both 3.5%, that's FHA, and 5% are available. So that's conforming, Fannie Mae, Freddie Mac. Now, there is a qualifier to that. It depends on the location of the property. For example, it depends on the county. Now, in this case, that conversation I had was with friends who are in Orange County. Well, in Orange County, we do have what's called the high balance or conforming high balance category. In fact, both LA and Orange County. And in those counties, you can get a conforming agency jumbo high balance loan at that purchase price level with only a 5% down payment. If you want to go FHA, again, in those counties, you can get that loan at that 1.125 million purchase price with only a 3.5% down payment. Now, I'm not naive. Obviously, if you're going to put that little down, your monthly payment's going to be really up there. So affordability is an issue as to calculating your debt to income ratio. But in a lot of cases, and I believe it was true with these folks, their income was at very high levels. They were challenged on down payment amount, but they were thrilled to realize and learn that they could buy $1 million home with a minimal 3 to 5% down payment, 3.5 to 5% down payment. So again, trying to knock down that perception that you need 10 to 20% down to buy. That is oftentimes not the case. And by the way, in this kind of scenario, if it's LA Orange County, I would argue that FHA is usually going to have the edge in terms of not just how the loan's priced, but in qualifying on that debt ratio, because FHA allows a higher debt ratio limit than a conventional conforming loan. And then one other comment, some markets or counties like the one I'm in right now, Riverside or San Bernardino, we don't have an agency high balance category. But that doesn't negate the fact that, with the current conforming limit of 726,200, you can buy a home essentially at around 750, 760 purchase price level with a 3.5 to 5% down payment. So again, another example of you don't need that bigger 10 to 20% down to be able to purchase that home. So with that, let me go ahead and give you next week's closing question. It's kind of interesting. With rates having been higher as they've been for the last year or so, it has created affordability issues for many prospective home buyers. And this has triggered renewed focus on manufactured homes as an affordable option. I get a lot more calls about manufactured homes than I have in past years. I always do a few every year, but this year seems to be a lot more interest in those. And so here's our question. Can a prospective home buyer finance a single-wide manufactured home built in 1976 with a minimum down payment? So think about that. Feel free to research it if you like. But next week, I'll provide you some answers on that. And remember, when I do, those answers will be on the house. Jeff, back to you.
Well, it's such a relief. I could feel the tension level in the entire show go down a few notches. It was very nice. So good news. It sounds like activity. Tell us, what did you notice right away? Because this is one of those things. It's like, it doesn't take long before things start to happen in your office. So tell us, has this started making a difference in the phone calls and activity on your side?
Yeah, it has. Now, I think that, I don't know how much folks have fully digested the improvement in rates this week, and maybe a little bit of a seasonal issue. We're still in the summertime. There's still folks who may be wanting to look at buying a home before the fall when school starts and all that. So I think it's probably a combination of things. What I hope happen, if we get any more improvement and we can get not just the government FHA, VA loans, back into the fives like we are now, I would say in particular, if we can start to see conforming loans get a little bit better, get under that 6% threshold. So they're in the fives too, like we were about 3-4 months ago, early 2023, we were at that level. At that time, I was saying, folks, we're in the fives. That ain't so bad. If you're on the fence, you ought to really look at, buying a home sooner than later, work with those rate levels, temporary buy downs, permanent buy downs. I've talked about that, many, many times. I think if we're very close to getting back to those levels. And if so, that's a second chance. I don't think people should pass up.
Yeah. What do you think is this going to do anything, do you feel like, with the people who are in that category where they have a low rate? Are they going to still hold on to those rates, or they're now more willing to look at possibly moving up or getting their forever dream home?
Well, I guess the way I would put it is I think they should start thinking seriously about doing that, despite the fact that they have that very low rate. Again, if they're a household that's determined that their current housing, while they may love it, it may not suit their needs anymore. Life changes. They could have additional kids. Who knows? and they may have a desire to sell that home, move up into a bigger, nicer home, et cetera. And I think what they ought to realize that, again, if we're starting to settle back down into those levels, into the fives, high fives, again, it's that second chance. And so I don't think they should let that pass by, particularly given, as I covered earlier in the program, I tend to believe that Black Knight forecast is more accurate as to what's going to happen to home prices going forward. And if these inflation numbers continue to cool, that's only going to be good for the bond market. It's going to be good for mortgage rates. And as Barbara Corcoran said, as we mentioned about a month ago, home prices are going to go through the roof. So if you wait too long because you have that 3% mortgage, you may find yourself, okay, rates have been, they dropped under 4, it's time to buy. But that home you were looking at may not be at the same price level as it was. It may be 10 or 20% higher, and that can undermine, the benefit of that lower rate. So I don't know. I think they ought to reconsider and maybe act now. I think it may be a good time. So.
Can you give us any indication of what inventory levels? You mentioned it in today's program, but can you give us any indication, let's say in the Riverside County or LA or Orange County, what the inventory levels look like? Are they drastically under what they should be? Are there still plenty of homes out there, for people to find?
Yeah, inventory is still significantly below, normal environments. It's always been said that a normal market, you're going to have inventory that's equal to about 6 months worth of sales, 6 months worth of inventory based on the sales rate. Even in, our Riverside County, San Bernardino, LA, pretty much most of Southern California, still well below that. The inventory levels based on current sales rate, it's more like 2 to 3 months supply. So it's still tight. Now, in some areas, like, for example, I would say here in the Coachella Valley, condos, you tend to see longer days on market, maybe, or getting closer to back to normal. Whereas, as I mentioned earlier, those couple of transactions we were doing recently, South Orange County, no, inventory is low. And as a consequence, those prices are, you still have to possibly offer more than list just to get the home. So overall, there are some local market differences, but they're not substantial. I think overall, the trend is still inventories well below normal. So that's what's keeping prices up.
Well, Art, we see that your information is on the screen there. You can get a hold of Art at his office, 760-883-5700, or you can call him on his cell phone. I think he sleeps with his cell phone, and the ringer is always on because that's what's happening with the real estate market. It is always on, 714-612-9035. And, of course, you can visit the website you saw earlier in the show to see what the rates are. He's updating that all the time. And then also you can drop him an email at art@mwloan.com. So again, maybe you want to jot those numbers down. 714-612-9035 is cell, and 760-883-5700 is the office. Before I let you go, Art, if you could help us define, hey, where are you able to create loans for people wanting to buy homes? Or let's be honest, we not only just buy homes, but like home equity lines of credit. You've talked about reverse mortgages, things like that. Are you subject to certain areas, or do you have a pretty large market they service?
I have a large market. I can make loans anywhere in California, and I can make all the loans you mentioned. We do, conforming first, jumbos on 1 to 4 unit properties. We even occasionally do commercial loans. I've got multiple retirement mortgage options, like the traditional HECM reverse mortgage, as well as that equity avail product we mentioned recently. And again, I can do those anywhere in California. Home equity lending, I think, is still a very viable segment of the market that folks should look at. Again, if you're not convinced that you own a home and you got a 3% mortgage and you're not convinced you want to sell it yet and buy another, home equity lending is still a great option to be able to, do some stuff to your home to make it the way you want it. Or if you're interested in getting into residential rental real estate, use the equity in your current home as a source of down payment to enter the rental market and maybe start to develop a portfolio of rental property that might set you up for the future. So I always suggest that people should keep that in mind. If they have a lot of equity, they don't want to touch their first mortgage rate, and they want to use that equity for building wealth, basically.
Art, are these the type of questions? Can people call you and ask you and have a conversation with you about things like that? Even though it's like, hey, I don't want to apply for a loan right now, but I'm asking these situations. Can you help them out with that?
Sure. In fact, that's probably what I love to do more than anything. In fact, actually, it's funny we mentioned about equity lending. I had a past client. I closed his purchase loan about 3 years ago. He has a very low rate first mortgage, and he was calling me about a HELOC. And the reason was to consolidate a little bit of debt, but he wants to spruce up. I basically, do a bunch of nice stuff to his backyard.
Mm.
And he made an interesting comment. One of the things I try to do is I try to be very thorough and kind of talk in plain language about, mortgages and how they work and, how you qualify and all the criteria. And one of the things he commented on is he likes calling me because I explain things thoroughly and in simple language that he can understand. So that's something I pride myself on, and I'm very open about that. And I'm happy to take as much time as possible to help folks understand the whole concept of mortgages and the process, because it is complex and there's a lot of misinformation and misunderstanding of what's involved. And that's what I like to help people understand better. So.
Well, I think it's nice to know that, a lot of times when we have these conversations between my wife and I, it's like we're only going through, hey, what we feel or what we've read. And as you said, these headlines, be aware of those. So one minute we could be thinking, hey, we need to do something right away. The next minute is like, oh, don't do anything. Right. And so the nice thing is you have your thumb on the pulse of what's really happening, and you can help us be part of that data research. Is that fair to say?
I think that is fair to say. Yep. That's what we do very well.
Fantastic. Well, Art, once again, thank you so much for joining us today and sharing this information. And again, good news is going, like you said, it looks like a run on Mammoth Mountain, and that's a good thing for us as home buyers, refinancing or home equity lines of credit. It is a good thing. So, Art, with that, I'll let you go, and have a great week, everybody. We'll see you next Tuesday or next Thursday. Remember, every Thursday at 2 p.m., you can join Art live and ask a question, and he will answer it because, as he says,
we have the answers and they're on the house.
Thank you, Art. Have a great week.
Thanks, Jeff. Thanks, everybody. Take care.